December 8th, 2023. I thought it was important to note that we were at essentially the top of what has been a tight trading range. You can see we were trying to break out at the top, and you notice that the high of this is for 46.0775. And when you're in a tight trading range, the market is going to try and break out, but you have to be very careful buying in that area. In 46.0775 is right here. So that's why, that's what I think this was. This was a vacuum test at the top of the range. But if it's testing the top of the range and you're buying up here, you need to be really careful. You're buying, directly into pretty major resistance. So that's one of the reasons why this happened, and it happened so fast, is because traders, who are buying up here, a lot of them are scalping out, and the ones who didn't scalp out are exiting pretty quickly below 12, and that's causing 13, etc., 14, etc. So bar one, bull bar, but a tail on the top in the middle of yesterday's trading range. We're opening, below this trading range. So we might get vacuumed back into it, probably going at least a little bit higher. Bad follow through on bar two, which is to be expected when you get a bar like one with a big tail on the top. And then a big bull surprise on bar three. If you sold above two, you're probably pretty disappointed in how three closed. So a lot of those traders are scaling in, but they're looking to, essentially scale in and get out. And that's what happened at the high of six, or at the low of six. So the low of six touched the high of two, where the traders who sold above two were able to scale in higher and get out around break even on their first entry with profit on their second entry. So three, disappointing for the bears. Bulls who bought above three were hoping that the bears who sold above this would see this as enough evidence that this could be a bull trend and that they would give up above three and we would get another big strong bull bar on bar four. However, that's not what happened. Traders ended up selling and you get a disappointing follow through bar on three. So if you bought above three and you see four, it's reasonably likely we're going to get back to the two high. So a lot of those traders will exit around break even, and you can see as five trades up to the entry price of the traders who sold above three. Bought above three. So you buy above three, disappointed four. Those traders are exiting around break even, causing five to sell off. Can you sell below five? I don't think it's a very good idea. This could be a tight bull channel. You'd be selling the bottom of the tight bull channel, but I think it's more important to note that you're selling at the two high, you're selling essentially at the two high, right? If you're selling below five, you're hoping for a collapse and you're hoping we're going to test somewhere down here. But really what's happening is you're selling right where other bears are going to be buying. I mean, that the bears who sold above here are disappointed in how this looked. So they're going to look to get out around break even. There's a low probability chance that six is going to be a big bear bar as well. That looks pretty similar to five. And if that happens, you can just sell on bar six instead of bar five. And, you'll make a little less, but you'll save a lot more, money in the long run, not just losing those trades constantly. Six is a reversal up. Would I buy above six? I think you probably can. Three is big enough for a second leg, but it could be one, pullback, two, pullback, three. So maybe you can, but it's right on the moving average. I personally probably would not buy above six. And then you get a big bull surprise on seven. Probably going at least a little bit higher. I think seven resets the market cycle, and it makes me think that we're, probably going to race towards the top of this channel here. Additionally, though, one strong argument for buying above six is if you did sell below five, you have to get out above six. Traders who sell below five are not going to hold through six because their premise was that we were going to get a collapse. And if you sold below five and you don't get that collapse, you need to get out. So traders will exit above there. I think it's reasonable to buy the breakout above this high, thinking that, any bear who got stubborn and decided to hold is going to get stopped out above this high. So you have some bear stops above the five high. And as we trade above it during seven, those stops are getting run. And that's causing the big, the bull bar on seven to get even larger. Eight is a good follow through bar for the bulls, but a big tail on the bottom. So it's good, but maybe not great. And additionally, you have to keep in mind that limit order bears were able to make money earlier. So you have to be wondering if they're going to make money again. Nine, more follow through, but again, small body, big tail. And we have a tail on eight and a tail on nine. So this is potentially a wedge. If you look at, 10 o'clock through 10:10 on a 1 minute chart. So 10 o'clock, essentially a spike up, and then the channel, and, one, pullback, two, pullback, three. So it's consecutive buy climaxes. So, you can be long up here, but that we have pretty major resistance right here, and these big tails are signs of waning momentum. So it's really not as great as it could be. The follow through on 10 is, not great as well. It closes, I think, a little bit above its midpoint. Closes slightly above its midpoint, but big tail on the top, so that's really not what you wanted to see. 11 is another disappointing bar for the Bulls. Bulls were hoping we were going to get a strong rally, and bars were going to look a lot like 7, and we were just going to keep printing bull bars and get a big rally. But there's big tails on all these bars instead. It's not as good as it could be. It's still okay to be long, but I think if you're long, you're getting ready to exit because you know that the most likely scenario is that we're going to get a deep pullback. While it's true all of this is strong enough for a second leg, the deep pullback could be pretty deep. And then you get 12, and I think a lot of traders are just going to exit below 12. Again, we still should get a second leg up, but you don't know how deep the pullback is going to be, and it could pretty easily be 10 bars, 2 legs. Something to note is, when you get, oftentimes corrections are about half the amount of bars that moves are, and this was a 6-bar move, and the correction was 3 bars. So a lot of times, corrections are generally about half the size of a move. Follow through for the Bears on 13. It's okay to sell the close of 13, but I think it's kind of like buying up here. You probably want to scalp out. I mean, if you're selling the close of 13, you're hoping you get big follow through, but you got to realize that a lot of traders are going to end up scalping out if you do get good follow through, because you're now in the middle of a trading range, and this is looking more like big up, big down. And additionally, this probably still needs a second leg, and you're not sure exactly where it's going to come or how it's going to look. So follow through on 14. A lot of bears, if you sell below 13, you have zero true risk. They'll just take the profit on the close of 14, and that's causing the buying pressure on 15. The tail on 16 tries to dip down and touch the close of 14. Probably, second leg sideways to down. This should get a second leg sideways to down, and you can make an argument that the tail on 16 was the sideways second leg. But you could also, make the argument that 12, 13, and 14 were really strong. We're probably going to need more of a second leg. But if you're short for any reason, if you sold 12, 13, 14, whatever, you need to exit above 16 since it's a pair of consecutive bull bars. Can the Bulls buy above 16? I think so. You are kind of buying in the middle of a trading range, which isn't great. But you know that this is probably strong enough to get another leg up. And this was stronger than this. So it's reasonable to think we're starting that second leg up. And you think we might have to test the low of 11 because Bulls bought below 11. And, is this a bear trend day? Probably not. It's probably a trading range day, worst case for the Bulls. So if you bought below 11, you're probably going to be able to buy more lower and get out around break even on your first entry with a profit on your second entry. So Bulls, they buy above 16, and they get good follow through on 17, basically getting, vacuuming up towards the low. Can you buy the close of 17? It's kind of the same thing as selling the close of 14. This seems like we're at the top of a trading range. This is probably strong enough for another leg down. So I don't think that we're going to, what's your goal if you're buying the close of 17? Do you think we're going to continue to race up all the way up here without, at least retesting first? Probably not. So that's my problem with buying the close of 17 and 18 is your risk reward is bad. If you're buying the close of 17, you want to get all the way up here. And what are the odds that we get all the way up here before we, get a pretty deep pullback? The odds are pretty low. So that's why, buying the close of 17 and the close of 18, not all that good idea. And it's the same reason why selling the close of 14 isn't all that good of a good idea. You think we're going to collapse directly down to the low of the day before this measured move, before we get the second leg up for the Bulls? If you're selling the close of 14, you have to have a stop probably above here, and you have to just kind of, you have to either exit quickly or just let it go and just hope that you're eventually going to get to your exit price. Just want to see something real quick. Okay. Anyways, so 18 bull bar, but the top of a trading range, probably not all that good. More of a profit taking bar than a buy the close bar. 19, a bear bar closing near its low. Not all that near its low, actually. It's probably closer to its midpoint, but it's still a bear bar. I wouldn't quite sell below it, but you get good follow through on 20, which is reasonable to sell the close of. This might still need a second leg, but you're definitely getting the second leg from this right now. And you have to think that when we get back to the 14 close, there'll probably be some buyers, and that's what happened on 21. That's why there was a tail. It's because there was buyers around the close of 14. However, traders sold the close of 21 because they had 3 straight bear bars. So 22, it's parabolic essentially. It's trying to get an even steeper breakout. And usually when you're trying to get a steeper breakout in a trading range, it's not going to happen. Generally only 25% of the time. More likely, spike and channel. Although it's notable that 19 through 22 is strong enough that we might need 3 legs down instead of 2. 23, bull bar, not a very strong close, or a strong close, but not a very big bar. So not the best buy above. You're hoping that it's 2 legs down and that you're going to get a second leg up from this. But I think that, with how strong this is, we probably need to go more sideways first. So anyone buying above 23 knows the reversal is probably minor, although they do get 2 to 1 of their true risk. And the fact that bulls were able to get 2 to 1 of their true risks should tell bears that, this probably isn't a bear trend. If you're buying in a bear trend, you should not be able to make 2 times your risk. However, here, the bulls who bought above 23 were able to make 2 times their risk, which makes you think this probably isn't a bear trend, and it's probably a trading range. You could also decipher that from, the strong bull moves from 6 to 11 and 15 to 18, probably canceling out the strength of the bear moves. So it's most likely a trading range anyways. But if you do buy above 23, it's probably a minor reversal, and you're probably going to get another leg down, another leg sideways to down. But, traders are surprised they were able to make 2 to 1. 24, follow through. 25, kind of bad follow through, same as 24, but it touches that area where bulls were able to make 2 to 1 and they exit their longs. Anyone who bought, anywhere, anytime during 24 had a chance to get out during 26, and they did. They sold. And this big bear bar on 26. Second leg down from 19 to 22. We might have to get back to the open of the day. If you'll notice, the traders, even if you sold below 7, if you do something reasonable, it wasn't great, but it was reasonable. Sorry, 5, not 7. If you sold below 5, it was reasonable. It wasn't great, but it was reasonable. And usually on trading range days, if you do something reasonable, the market's going to let you out without a loss if you're willing to scale in. And so that's one of the reasons why when we started to get over here, I started thinking maybe we were going to get back up here. 60% chance in general that we were going to get back up here. Maybe 80% chance we're going to get to the midpoint, which is right over here. Bad follow through for the bears on 27, probably going to pull back. This is, turning into a channel. Bears not selling the low, they're using it to take profits. Bears not selling the low, they're using it to take profits. So 27, doji follow through bar, bears taking profits, 28, 29. These bull bars are pretty much just profit taking for the bears. Some bulls will be buying below this low and scaling in lower, maybe 5 points. I don't think it went that far. Did not quite get that far. Maybe a little bit less. And 30, it's a low one short for the bears towards the channel line, but on a like rate, it's a bull bar. 31, bad follow through for the bears. 32, inside bar, a potential swing short. You're on the channel line, it's a low 2. It's probably an okay sell, but you're selling a third push at the bottom of the trading range. I thought this was strong enough to get 3 legs, so 1, 2, 3. Rather than counting 1, 2, 3, or in 4, but you could do that too. They're all lower highs. It's all constant lower highs and lower lows. So that's important. But follow through for the bears on 33. If you sold below 32, you were able to make 5 points. And then you get a big reversal up on 34. What about selling 33? I wouldn't sell 33. I think 33, you're selling towards the bottom of the channel, a couple pushes down, and you're selling at the bottom of a trading range in general. That's why I don't like any of these really, is you're selling at the bottom of a trading range. But I thought 34 was probably a pretty strong buy. You're buying towards the lower third of the range. It's closer, more in the middle, but it's towards the lower third in general. It's also a test of the open of the day. So on trading range days, the market likes to test the open. And 34 does test the open of the day. A lot of the traders selling below 32 were just trying to get towards the open, because that's a reasonable trader's equation with how small your risk is. If that makes sense. But we weren't, those traders were not quite let out. But exactly the open of the day is where that, the 2 to 1 of their true risk was. 34, big bull bar closing, pretty much on its high. It's a couple legs down in a trading range. We're probably going to get at least 2 legs sideways to up. You're just not totally sure how it's going to look yet. 34 is a big bar, kind of near the moving average. So it's likely that we're going to get, slower follow through. When you're buying a bar like 34, with how strong this is, we're probably going to go sideways to up. We're not just going to race straight up. It's pretty unlikely that we'll do that. So when you get kind of bad follow through on 35, you probably just have to stay long. I think this is one of those ones, it's kind of an always in flip if you're buying above 34. It's an always in flip. So, it's one of those trades that you want to hold for, until it's clearly not always in long anymore. It isn't a trading range. So I kind of thought, the way a lot of traders who manage their trades today, I'll just put a little note that I was on bar 34. I thought, a lot of the ways trades can manage their trades today is you could buy above, you could buy above 7, scalp out around 2-1. That's fine. You could buy above 8, probably, I don't think you get 2-1, but you probably get 1-1. Or, try to make 5 points. I don't think traders above here made 5 points. Oh, they did. So you could have bought above 8 and made 5 points. You could have bought above, you can see actually exactly if you bought above 7, you made 10 points. And those are all reasonable targets with how little your true risk is. Or you could hold and then exit below 12 when it becomes always, when you need to get out. And then you can probably sell below 13. And some traders, they sell below 13, they get 14, they just scalp out on the close of 14. Some traders buy above 16, or some traders wait until 16 when, they know bulls might buy, and they'll exit above 16, and that'll cause, 17. And some traders who bought, 16 know that it's probably only getting back to the low of 11 at best, and they have basically no true risk. So traders will take profits on the close of this bar, causing this tail, or they'll take profits on the close of 18 or around this low, essentially. And that's causing 19. Some traders will wait until they have to get out below 19. And then, maybe they'll sell below 20 and, probably get out above 23, or, you can probably hold through that. But my overall point is, there are different ways to manage it. If you're a trader who scalps out more often, maybe you make the full 10 points here. And then here, you're able to make what? We'll say 5 points because I think 5 points is reasonable. So you made 10 points, you made 5 points. Maybe up here, you made, I promise there's a point to this, by the way. You made 9. I think you could have made 10 points above this high, 97.25, and it needed to get to 4607.75. That's right. Hold on. Okay, yeah. So those bulls were two ticks short of making 10 points. But maybe you scalped out at this low for 9 points, whatever. But then when you bought above this bar and you got kind of bad follow through, a lot of traders will scalp out for 5 points, or you can see up here, you weren't quite able to get out with 10 points here. So maybe those traders, you're 1 tick short. So those traders might exit below here, or potentially hold through this. But the point is, if you're scalping out of all these, you're doing well over here, but then you might scalp out with 5 points over here and miss the last, I don't know, because you probably had to exit below 67. So you missed the last 12 points first, but you made 15 points in the opening range. Versus if you manage it the other way, you only make, rather than 10 points, you make 4 points here. Rather than, 5 points, you make, a point. So you're really only at 5 points so far in this range. And then if you were holding for the, super, or over here, you probably make, 3 or 4 points. So, you probably make 15 points in the opening range here, scalping out, in and out. And you probably make, less than 10, maybe 6 or 7, maybe 8, in this range holding for the always in. But if you just continuously hold for always in over here, you make up for that. So there are lots of different ways to trade. It's essentially both always in trading, but there are different ways to manage it. And, if you get really good at trading, you'll understand that, these are areas where you should be scalping out, and then taking a trade buying at the bottom of a trading range is maybe a better trade to hold for an always in swing. Additionally, we still haven't broken out of the 18 bar range yet, and you have a credible swing. So it's possible we get all the way up here, and that there's a magnet in the bar 18 close. So maybe it's better to continue to hold. So follow through 35, 36, but tail on 35, tail on 36, not all that great. Doji on 37, doji on 38, essentially a high one above 38. If you, or I'll say this, once you get 39, 40, 41, if you're looking at this and you're thinking to yourself, well, I really wish I would have bought above 34 because now I can see that we went this far. And then you think to yourself, where would my stop be if I had bought above 34? You think, well, I bought above 34 and we're up here, so it's probably too far to have my stop below the low of the day, or below 34. So you probably have a stop maybe below 36 or below 35. And you're thinking to yourself, if I was long above here, my stop would be below 35. You can just buy at the market and put your stop below 35, as long as, if you were thinking that of something that, and how you would manage the trade, if you had bought earlier, then you can just buy at the market at that point and manage the trade the same way. It doesn't really matter. But 42 doji follow through bar, 43 doji, basically a micro channel. I have a couple examples of micro channels, not very many. I don't know how good they are. Exactly a micro channel. It's more of a tight channel. Oh, I guess that was a micro channel. Hold on. I don't know why this isn't popping up for me. There's usually something to let me change the. But micro channel, micro channels. Micro channels can go on for a lot longer than you expect them to. And that's one of the reasons why traders will just hold through it. And then 45 tries to break out above the micro channel, but generally, if you're trying to break out above a channel, it's not all that great. So 45 is probably going to lead to a pullback. And you can see on 46, bulls who bought above 34 were one tick shy of coming up with 10 points. So you get traders starting to exit during 46, just thinking, well, better to just get out now and look to buy again later. 47, a high of 1. But if you buy above 47, you probably got to be willing to buy more lower. And you get disappointing follow through on 48. I think if you bought above 47, you just get out on the close of 48. If you bought above 47, you were kind of hoping that a lot of bulls got trapped out and you're going to get essentially a vacuum test of the 18 close, and you just get a disappointing bar on 48. So it makes more sense to get out. If you do hold through 49, I think you definitely get out around break even on the close of 49. You can see for the 49 close is right at the 47 high. And I think I would just get out there. That's why you get a bear bar. And then, the very last, I think always in traders, probably getting out below 50. And a bear bar closing near its low on 51, but not a good sell right on the moving average. Probably more buyers below if we do get below, and we don't even get below it. So some traders, they're long and they exit maybe below here or at some point in here, and they'll buy again above 52 because 52 is a good bull bar closing near its high. Other traders will buy the breakout. Others will buy above another bull bar closing near its high, but bad follow through 53. It's a big bar, so it's not super surprising. And if you're buying above here, you just have to be thinking back to what was your premise if you bought above 34. If you bought above 34 and you held through this, I thought your premise remained intact the whole time that we might get back to the 18 close or even the 11 close. And if we get up here, 90% chance in general on days we're going to break out of the 18 bar range. So if we get up there, we might just get all the way up to here. And I think buying above 52, I think it's pretty likely we're going to get here, reasonably likely we're going to get here. And if we get to both of those places, it's not unfathomable to think we're going to get up here. So you end up getting another micro channel. You could call this whole thing one micro channel. I wonder if there's some sort of leg one, leg two. I'm not sure. More or less. But anyways, bull micro channel all the way up. You can buy, it's a micro channel. You can buy above this bar. You can probably buy the bear close. You can buy any of these bull closes. You can buy below this bar. Traders buying for any reason, though you're getting pretty high in the range at this point. But you can buy pretty much any of these closes. And then you can see we get a climactic breakout above the channel, right? So this is the top of the channel. And 70% of the time when you get a breakout above a channel, it's going to fail and retest the other side of the channel, which is exactly what happened here. So we broke out to the high, and then it fails on 66 and retests down on 67, 68. And then we pretty much just went sideways into the close. For swings on the day, or just, always in trading, I thought it was okay to buy above 7 or 8, maybe even 9, but that the body is small, and this is becoming more of trading range bars than anything else. And, you don't have an open gap here. Bears were let out at break even, so that's a problem. And then probably exit below 12. You can sell 13, but you have to exit above 16. You can buy above 16, but I think it, best to try and scalp out up here, or at least a piece of it. It's always okay to scalp a piece and then exit below here. You could probably sell 20. You don't really have to exit until 34, but better to get out low if you can, or around the open of the day, which is always a magnet. And then obviously buy above 34, and you can pretty much hold if you wanted to. On the daily chart, we're trying to get a breakout above this high. I think the bears who sold above this bar, the December 6th, they're going to make money. So I think we'll probably at least pull back to this high. And we might get dragged back into the middle of the tight trading range. And on the weekly chart, I think bulls got another bull close. Yep. So we have 6 straight bull closes on the weekly chart. Really, really strong for the bulls. So I do think we're going to end up having to pull back at some point because we're towards the top of the trading range. But overall, a strong bull channel, and we're probably going to get higher prices. That's the